a major Chinese cement producer, with products used across housing and commercial building, roads and bridges, and the backbone of national infrastructure. That's Anhui Conch Cement. The backdrop has been brutally hard. China's property downturn, structural overcapacity, weak pricing, and lower utilization pressuring margins. In this video, we'll break down the company's business model, translate it into financials, and assess the company's long-term prospects. The story starts in Anhui. Assets were consolidated under Conch Holdings in 1996. A year later came the Hong Kong listing, with Shanghai following in 2002, all run from Wuhu. The 2000s were about nationwide build-out and housekeeping, share segregation in 2006, asset injections in 2007. From 2017, Conch stepped beyond China into Southeast and Central Asia, establishing joint ventures by 2023. Anhui Conch Cement is one of China's largest cement producers. And its products are widely used across the stuff that binds the country's highways and metro lines, the foundations of housing and industrial parks, the dams and airports that knit regions together. The group runs a fully integrated model. It starts at the quarry. Limestone goes into modern preheater pre-calciner kilns to produce clinker. The clinker is milled with gypsum and a few additives into mainstream cement, mostly 42.5 and 32.5. Downstream come aggregates, sand and ready-mix concrete, all supported by in-house energy and logistics to lower unit costs and keep material flowing. The chain matters. Quarry control secures long-life limestone. Kiln technology and heat recovery systems convert that rock efficiently into clinker. Finishing and distribution turn clinker into revenue. In 2024, self-produced cement, mostly grade 42.5, still carried the franchise, roughly 70+% of sales, while 32.5 cement added a low-tin slice. Commodity clinker, aggregate sand, and ready-mix concrete made up most of the rest, and trading stayed marginal. The channel is balanced, a little under 60% sold direct, 40% via distributors. Geography remains overwhelmingly domestic. Overseas subsidiaries contributed a mid-single-digit share of revenue, even as management accelerated build-outs in Uzbekistan and Southeast Asia. Revenue runs in two phases. It climbs from 51 billion RMB in 2015 to 176.5 billion RMB in 2020, then declines to 91 billion RMB in 2024, equivalent to a 6.6% CAGR over 2015-2024 across a strong first leg and a weak second leg. On the same chart, EV to revenue rises from 0.93x in 2023 to 1.51x, mainly because the denominator fell in 2024, revenue down. In absolute terms, 1.51x for a cyclical, capital-intensive building materials business is moderate. In H1 2025, revenue was 41.3 billion RMB, down 9.4% year-on-year, mainly reflecting a deliberate pullback from low-margin trading and softer service demand. Sales and trading of other materials fell to 5.11 billion RMB from 9.75 billion RMB, and service income to 1.34 billion RMB from 1.76 billion RMB, while core cement clinker edged higher on roughly flat volumes. The step down in revenue after 2020 lines up with the utilization chart. Conch's network ran close to 90% through 2015-2020, then slid to the high 70s in 2021 and into the low 70s in 2022-2023 as demand faltered and pricing discipline frayed, before touching the mid-60s in 2024. That is the core mechanical driver of the revenue reset. Kilns and grading stations are capital-intensive assets. When hours fall, fixed costs spreads over fewer tons and price competition intensifies. From the top line to EBITDA, two elements dominate: energy and everything else. In 2024, fuel and power made up just over half of the cost of self-produced products. Raw materials such as gypsum and mineral additives were around 1/5. Depreciation sat near the high single digits, staff costs a mid-single digit slice, with other items filling the rest. That mix explains the margin path in the next chart. As utilization fell and coal power costs spiked into 2021-2022, EBITDA margin compressed from mid-30s% pre-2020 to 13% in 2022 before recovering to 20-21% as energy eased and the company pushed operating discipline. Energy is the swing factor, because cement kilns are heat machines. Conch kilns mostly burn coal and the plants use a lot of electricity. To counter that, it does three things: makes power from waste heat across most lines, adds on-site solar, and raises alternative fuels which already replace 10% of coal at several sites. The goal: burn less coal, buy less power, and squeeze kilowatt-hour and kilocalorie per ton. Competition in China is regional and intense. CNBM Tianshan is the biggest state-backed group. Conch is one of the largest non-state players with a broad footprint. Huaxin, CR Cement, and West China Cement are strong in their home regions. Cement is local, so share is best read by region, but as a national yardstick. Conch sold 268 million tons of self-produced cement and clinker in 2024 versus 1.825 billion tons of national output, roughly high single digits to low teens. Its edge: scale, reversion logistics, and lower energy per ton. The structural headwind is overcapacity. National output has slid with a real estate slump, but capacity stayed high, so weak demand brings price wars. Conch flags the risk: utilization pressure and cutthroat competition, exactly what the 2022-2024 utilization and margin charts show. In response, it's diversifying at the margin. Overseas plants in Southeast Asia and Uzbekistan are ramping, with new clinker cement capacity added in H1 2025 and more coming. Overseas revenue was just over 6% in 2024, up from near zero 5 years ago. EPS mirrors that cycle, steady gains through 2019-2020, then a sharp drop in 2022-2024 as utilization and pricing fell and energy costs rose. H1 2025 EPS came in at 0.88 RMB, up approximately 31 to 33% year-on-year, despite a lower revenue, helped by better prices and lower costs that lifted gross profit. Policy is the swing variable to watch. Beijing is tightening capacity replacement and relocation rules so that new kilns only replace old ones rather than add net capacity. Banks are less inclined to fund surplus sectors, and the national ETS knock over cement, putting a rising price on inefficient lines. Conch's disclosures point to ultra-low emission retrofits across dozens of lines and a formal mid to long-term carbon route, which positions the group to benefit if enforcement bites and smaller high-cost plants exit. The thesis is straightforward. Stricter rules plus carbon costs should push consolidation and raise average utilization over time. As expected, this is a heavier set business. PPE per share rose from 12.1 CNY in 2015 to 20.45 CNY in 2024, about a 6% CAGR as Conch expanded and retrofitted its plant base. On the same chart, market cap to tangible equity moved from 1.36x mid-cycle to 0.78x today, meaning the equity trades below tangible book. Balance sheet remains conservative. Conch shifted from net cash in 2018-2021 to modest net debt as the cycle turned. Net debt 12.8 billion CNY in 2024, with net debt to EBITDA 0.66x on the low side, especially after the EBITDA decline. This is a capex-hungry business. Kilns, grinding, quarries, logistics, and now on-site power. Capex ran 8 to 9% of sales in 2015-2016, eased to 3-5% pre-COVID, then climbed to 7-11% from 2021-2024. Post-2021, the uptick is straightforward. Compliance upgrades, energy self-helped, and in-flight projects, plus selective downstream ads amplified by pre-committed spend and a smaller revenue base. Free cash flow is cyclical, and the post-2021 capex step-up is what drove the sharp deterioration. Free cash flow turned negative in 2022, then recovered in 2023-2024 as spending eased and working capital normalized, but remains well below the 2019 peak. Over 2015-2024, free cash flow per share rises from 0.82 CNY to 1.52 CNY, 7% CAGR. Price to free cash flow has reset from 20.3x in 2023 to 15.5x on today's price versus 2024 free cash flow per share, a level that remains relatively high because the denominator, free cash flow, is still depressed. Anhui Conch Cement pays cash dividends under a stated minimum payout policy, and distributions track earnings. DPS climbed into 2021 2.38 CNY, then stepped down with the cycle to 0.71 CNY in 2024. The group usually pays only a final, but in August 2025, it declared a rare 0.24 CNY interim. On today's price, financial year 2024 screens at 3% yield. On the long run log regression, today's share price, about 23.5 CNY, sits well below the trend line, roughly between the -1 sigma and -2 sigma bands, consistent with a downcycle and high volatility. At that level, the stock trades around 15.4x PE on financial year 2024 EPS and about 13.2x on a TTM through H1 25, a mid-teens multiple where the price remains below its historical mid-cycle anchor. Projecting 10 years out is difficult for this name. The more realistic thesis is a normalization trend, a recovery as China's property sector stabilizes and excess capacity is reduced, i.e., a gradual end to overproduction rather than a long-duration structural grower. The setup looks like a discount created by a deep down cycle, so the bet is on mean reversion rather than a multi-decade compounding story. Over the long run, demographics and a mature infrastructure base argue for more renovation, maintenance, and less new build, which does not support a rising structural demand trend for cement. Anhui Conch Cement is first and foremost an industrial machine. Integrated from quarry to concrete, close to demand, able to move huge volumes efficiently. That footprint and process discipline keep unit costs low and quality steady. Overseas plants add a small but growing second leg. Despite the downcycle and other headwinds, the balance sheet remains solid with low leverage. But this is a capital-intensive business. The need to keep investing in plants and energy projects weighs on free cash flow and makes it choppy. Long term, the picture isn't exciting. China's demographics and a mature infrastructure base most probably point to flatter or declining cement needs. This isn't a buy and hold forever story. The near to medium term case is a normalization trend. As housing completions stabilize and overproduction is cut in line with policy, utilization and pricing can recover, and the stock can re-rate over the next few years. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share. And if you want the consumer side view, watch my Haidilao video, the Hotpot Giants Playbook for service and scale.